Hey everybody, welcome to Accounting 112. This is the homework help for the accounting fundamentals. I'm showing you how to access it. You just click on the class. Again, you're going to see it a little differently because I can't launch it in Student View. So now I'm going to go into Student View into McGraw-Hill. And some people tell me, hey, sometimes you speak a little fast or I speak really slow. YouTube has the feature to slow down and speed up. So whatever floats your boat, if you want me to speed up, just you speed me up. If you want me to slow down, then you slow me down. I'll sound a little funny. I'm all right with that. All right, this first part here is classify each of the following accounts as an asset, liability, or equity. This is accounting fundamentals. We're trying to make sure that you understand and remember everything from Accounting 111. I don't know how long it was that you took it. Sometimes I have students who ask to be placed into 112 in lieu of 111 first because they have experience. This is here just to kind of show you kind of what we're looking at. So taxes payable, what type of account is it? Remember, payable is that buzzword. We're looking at liability there. Supplies, those are assets. Interest payable, again, the payables, the buzzword there. We're looking receivables, buzzword is asset. Um, all of these, I guess we're going to classify none of them as equity because your equipment, your cash, your prepaid rent, everything else is revenue or is an asset except for unearned ticket revenue, which is a liability. So I'm not gonna answer every single thing. Now look, you only have 2 check my works, right? So you want to make sure you answer these as thoroughly as possible before clicking this check my work button, all right? But we're going to check the work, make sure what we did is correct, and yes, on to the next one to show you how to do it. This one, again, we're now looking at it and identifying whether or not it's an asset, liability, equity, revenue, or expense. I will identify that rent revenue is indeed a revenue. Sometimes you got to scroll it down to find it. And that repair expense and salaries expense, these ones are expenses. Since I showed you what the other ones were, assets, liabilities beforehand, those are your examples there. Now, some of my students have said, well, hey, expenses and revenue are also an equity account, to which I say, even though, yes, they fall under it in the accounting equation, we never classify them as equity because they have a more specific designation of revenue and expense. So don't get lost in semantics with me. Just remember, we're going to classify them as low on that list as possible. All right. What are the normal balances? Okay. First of all, in order to identify what the normal balance is, you got to know if it's an asset, liability, equity, revenue, or an expense. So unearned revenue, unearned, that's the buzzword, liability. So liabilities normal balance, credit. Remember, if you need to remember that song, debits on the left, credits on the right, debit left, credit right, debit left, credit right. Okay. So we know that on the T account. But also, there's that one small part, which I thought they should have said that more instead of at the end of the song where you ain't born a high roll. They should have said this over and over again. An asset increasing is a debit. An asset decreasing is a credit. The opposite is true for liabilities and equity. They should have repeated that. That would have made more sense. But they didn't. Prepaid rent, that's an asset. Normal balance is a debit. Okay. And so on. So that should be pretty straightforward for you guys to be able to do. Then now this one, what decreases this account? Now, truck, what type of account is it? It's an asset. What increases it? A debit. So what decreases it? It's going to be a credit. Unearned ticket revenue, liability, normal balance is a credit. So to decrease it will be a debit, and so forth. Right. For the rest of these are going to be to show that you do indeed know how to do journal entries and financial statements. And I'm just going to do maybe one of these transactions because again, these should be stuff you should be able to do. At least it should be very familiar to where you can kind of pick through it. So the first one, again, it's going to give us all of them up here, but as you scroll down, you're going to see all the specific information here. T. James, which I find is funny. My son's name is Tyler James. I did not pick this. I just think it's awesome. Is the owner invested $21,000 cash in Sustain Company. $21,000. Let's analyze this transaction. We're getting cash as the company, and the owner is investing. So the owner's equity is increasing. So is the cash. Cash is an asset. Cash is listed first because it's going to be our debit because that's what increases an asset. We're also going to see T. James Capital increase in its normal balance as a credit. So we're going to increase it using a credit. I'll do one more. Company purchased $14,000 of furniture made from reclaimed wood. Like, we need to know that on credit. Okay, we don't care. We don't care what the wood's made of. We don't care about all that as accounts. We just worry about the finances of it. Let the executives worry about how it looks to everybody else. Okay. So our furniture, we're gonna have a furniture account. It's an asset. It's going to increase by the amount we paid for it. Then we are going to see that we bought it on credit, which means it's going to be in accounts payable. And that is a liability, so we're going to credit it. That's all you're doing here, all right? Now, all because I've shown you that there are only 2 journal entries in each one does not necessarily mean that that's going to be true for all of them. There could be 3 or 4 journal entries. You're going to have to, figure that out. Number 6 here, we're going to be preparing adjusting journal entries for the year end, December 31st, for each separate situation. Sorry for the loud noise. I could spend the time pausing, but by that time I would have, been done. Depreciation on the company's equipment is for the year is computed to be 14,000. Now, this is the last time you're ever going to see a question like this because you're going to be calculating depreciation in chapter 10. So you're going to just get it here. Well, our journal entry record depreciation. Depreciation is an expense, so we're going to go ahead and depreciation expense for the equipment, 14,000. That's the adjustment, and then we're going to credit our accumulated depreciation for the 14,000 because it is a contra asset account, meaning its balances are opposite of the assets, but it's included in the assets section. Let's look at one of these other ones. Again, this information should be familiar to you. You should be able to. Let's see if we can get paint up here so I can draw if I need to. Because I'm going to show you. Yeah, we're going to need a demo on this one. No problem here. Okay. So, prepaid insurance account had $5,000 debit balance at December 31st before adjusting for the cost of any expired coverage. An analysis of the company's insurance policy shows that we have $1,690 left of unexpired insurance coverage at the end of the accounting period. Let's go ahead and draw our T account. Whoa, let's do a better job at drawing our T account. I don't get to see my undo button because that thing up there. Go away, please. Thank you. All right, let's do this better. There we go. Now I forgot to hit the button to make it go straight. So this is our T account for our prepaid insurance. All right. Go ahead and type in. Go ahead and type in prepaid insurance. If you don't know me by now, I don't spell very well because we didn't have spell check when I was growing up, and my teacher who was supposed to teach me spelling decided to have a baby instead, and so I never really learned how to spell. Okay, so at the beginning, prepaid insurance is an asset. We have $5,000 in there. Put that little comma in there, make it look good. Okay, and at the end of the accounting period, we have $1,690 left. How do we go from a $5,000 debit balance to a $1,600 and $1,690 debit balance in that account? Well, we're gonna have to credit it to reduce it. Okay. Let's type this in here. And what we're going to do is we're going to just do some simple math here. We're going to take 5,000. We're going to subtract out 1,690. And, I could try and do it in my head and embarrass myself, but let's just pull up the calculator instead. I knew I had one in there somewhere. There we go. Okay, so we got 5,000 minus 1,690. So that's going to give us a $3,310 credit we need to adjust this account. So we're going to credit the prepaid insurance. I've already forgot what I said. What did I say? 3,000 and what? Oh, where's my calculator at? There it is. 3,310. Thank you. 3,310. All right, so we're going to credit our prepaid insurance because we've used it. Remember, we always put our credits after our debits. And our adjusting journal entries are always going to have one account that's on the income statement and one account that's on the balance sheet. This one's on the balance sheet, so we need an income statement account. Revenues or expenses. Which one do we use? Well, we're using an asset, so we're going to expense that. And if we use insurance there, we're going to debit our insurance expense of the same amount. All right, we're going to do that same maneuver for all of these up. You might sometimes know the beginning balance and what you used and need to calculate the ending balance. You're always going to have a beginning at least balance, but just that's all you're going to be doing. All right, is coming up with how to adjust these accounts. So there you go. That's how we're doing those. Let's go ahead and just check our work just so that you know. Again, you only have 2 of them for each question. Looks like we're good so far. But this is why you want to wait till the end of your assignment to check your answers. Remember to screenshot it when you do it, because if some of them are wrong, you're going to want to know which ones were wrong so you don't have to go back to the question, do the one that you saw that was wrong, and then forget where else it was wrong. So remember to at least screenshot it or take a picture or something. Excuse me for the burp. All right, and then the last section here, we're going to be doing closing entries and financial statements. So this is part 1 of 3. We're going to be preparing the income statement and then the statement of owner's equity. For my accounting 111 class, you know that you're just going to start down here with the stuff here, all right? You're going to start with your revenues and take out your expenses. Then you're going to deal with the capitals account and the withdrawals, bringing in your net income to that. And then the rest of it goes on the balance sheet. So it should be pretty easy. So revenues, 150,000 from trucking revenue. So we're going to go find trucking revenue here. 130,000, I think is what I said. 150,000. See, I don't put that into my short-term memory. It doesn't stick very well. Okay. We're going to come down here to expenses. We're going to start off with depreciation expense. Depreciation expense. And that was 25,000. And then what did I do? There we go. We're just going to list them all. Salaries, expense. Okay. And we're going to just put whatever the balance is over here, office supplies expense. You get the idea. Then we're going to calculate our total net income, all right? That should be carried over to here. We're going to go over here. We're going to say net income. We're going to add it. Whatever that is, we're going to put it here. Beginning capital balance, unless it says something here. Look at this. A. Wilson capital account balance was 190,000 at December 31st of the prior year. Hey, it's still the same amount. However, it's going to have to be because you could still have owner's contributions throughout that year. If it was 160,000 at December 31st of the prior year, and we look up here, we would know there was 30,000 of owner contributions throughout that year. That's how we would figure that out. But it's not the case. So that one's an easy one, 190,000. We just list it. All right. And then we come down here and we're going to withdrawals. We're going to take out our withdrawals by the owner. Okay. And the owner withdrew $22,000. Okay. Let's check our work. Now, again, it's not complete, but you get the idea of how to do this, right? So all this is correct. You just need to calculate net income. And then over here, oh, you probably, do they want that in a negative? Or did I put the wrong? Oh, 500. See, don't miss that 500. That's why that's wrong, all right? That should have been 500. So let's go back. But everything else was correct. Right? I'm going to check my work because I don't need to. But if I were doing this for real, then that was my last check on these 2 problems. So you want to make sure you ration those. All right. Next one you're going to do is you're going to do the balance sheet, at which point you're going to take the owner's capital there, and you're going to put it on the balance sheet over here. The bottom line is you got to know how to organize all this. Okay. So over here, you can go to current assets, and if it's total current assets there, then you can come over here, and what are we calling them here again? Plant assets, I guess. Okay. And I'm going to show you. Basically, you come up here and you just start going from cash, accounts receivable, office supplies. Those are all current assets. All right. We're not going to use all of these every single time. All right. So we're going to put cash, accounts receivable, office supplies. Right. All that's going to go here. Notice there's 2 empty spots. We're not using them. The book does this on purpose because they want you to demonstrate that you're not just turning your brain off and trying to find what it should be and fill in all the blanks. Okay. As an accountant, you've got to know that that's not how it works. You've got to know what goes in there. Plant assets. All right. Now we're going to look for trucks and our accumulated depreciation on our trucks and our land. Those are our plant assets, even though land could arguably be something else, but we haven't covered that in your classes yet, so we're not going to do that. So we're going to go ahead and put trucks and accumulated depreciation for trucks in these first two because it's going to net them out for us. All right. We're going to put trucks in here, and I'm showing you this specifically because I want you to remember how to do this. So you had $38,000 for trucks, and then our accumulated depreciation on it. I'm sorry, 38,000 was the accumulated depreciation, 192,000. Right? You're going to show this as a reduction. So you're going to have it subtracted there. Make sure you do that correctly. Then you got your land, all right? And you're going to come over here. You're going to hit your current liabilities. Well, let me make sure I did all the headers. You got it. Like you're going to miss points for headers, all right? And it'll say it's not complete. And you're going to scratch your head why in the crap isn't it complete? But it's because of these headers probably, right? So you're just going to come out here, fill in your current liabilities. Remember, current assets and current liabilities, the things that are going to be used or that you're going to have to pay back within 12 months, right? Or the accounting cycle. So when you come up here and look at current liabilities, we're looking at accounts payable, interest payable, those payables, unless it says long term like this one, these are going to be your current. This one will be your long term. And then your ending capital balance is really easy for equity in this. It's going to be harder once we go over corporate because they have a bunch of equity sections. It's K Wilson. We're going to go K Wilson capital, and whatever balance we calculated on the other ones is we're going to go here. All right. And then the last one, what you're going to do here is do your journal entries to close. Remember, it's whatever balance it is, it's going to go opposite. So we're closing our revenues, that's 150,000. Credit, we're going to debit revenues, trucking revenue for 150,000. Oops, I decided to throw a 3 in there. And our credit is going to be the income summary. Remember that account. Income summary is 150,000. That's our closing our revenues. Expenses are going to be opposite of that. You're going to have the income summary as the debit, and then you're going to list all your expenses, total it up, and put that amount in the income summary. Should be your net income. And you're going to close the income summary. If it's a net income, you're going to debit income summary. If it's a net loss, you're going to credit it. Pretty sure it's going to be a net income. So we go income summary, and we close it to the capital account. It was K something capital. Yeah, K Wilson capital. And then our last journal entry, we close our withdrawals account to the capital account. And whatever that was, I guess we can find that up here. 22,000. And if you're going to do a post-closing trial balance, it would basically be oops, let me do it from this side. It would basically be all these accounts, all the permanent accounts. All these other ones are temporary accounts. Okay, and that's your accounting fundamentals. Making sure you remember how to do all these. Remember, your numbers are going to be different because I've selected this to be algorithmic. But if you have any questions, again, feel free to get a hold of me. I'm happy to go over them again with you. Again, sorry if I'm talking too fast. Again, use that slow down feature that YouTube has. If I'm talking too slow, use that speed up feature. Okay. Anyway, you guys have a good one. We'll see you guys in the subsequent chapters. All right. And don't forget, submit when you're done with your work. Submit. All right, you guys. Take care.